Good morning, or good afternoon, everyone. Thanks for joining. This is Christy Schmidt, Director of Marketing and Communications for Farm Credit. Before we get started, just a few technology notes. All attendees will be muted throughout the presentation. Every once in a while, just be sure to tap your mouse so that your screen doesn't go to sleep during the presentation. And there will be time for questions and answers at the end of the presentation, but your questions can be text chatted in at any point during the presentation. You should see a box in the upper right-hand corner of your screen with a red arrow. Just expand that, and there will be a chat box, and you can type in your questions and send them to us. And finally, a recording of today's presentation will be available for viewing at a later time. You can access that at farmcrediteast.com/webinars. If you're having any trouble viewing it, feel free to give me a call at 800-562-2235. And now I'll pass it over to Bob Smith to get started.
Thank you, Christy, and good afternoon, everyone. Thank you for joining us today for this Knowledge Exchange webinar. We're very excited to present this webinar, and we welcome everybody that's participating, and we hope you find it to be very helpful, informative, insightful as we go along. This is part of a Farm Credit East commitment to hold webinars on topics of interest to the farm community, forest products community throughout the Northeast. We are very pleased today to have two excellent presenters with us from Farm Credit East. Caitlin McCulloch is a business consultant with Farm Credit East based out of our Auburn, Maine office. Caitlin works with clients on a variety of topics, including forming new entities and business plans relating to farming and natural resource ventures, transition, succession, and estate planning, benchmarking, and human resource management. Caitlin has her bachelor's degree in agribusiness and resource management from the University of Maine and her master's in agricultural economics from Colorado State University. Our other presenter today is Chris Lawton, the Farm Credit East Director of Knowledge Exchange. Based in Enfield, Connecticut, Chris runs our customer information programs, including our Knowledge Exchange Partner, which is our monthly e-newsletter, our webinar series, our live customer events, and our periodic reports such as Northeast Dairy Farm Summary. Chris holds his Bachelor's of Science degree in horticulture from Cornell University and his Master's of Business Administration degree from the University of Massachusetts at Amherst. Chris grew up in eastern Massachusetts where his family ran a greenhouse and nursery business. With that, again, I want to express our welcome to everybody that's participating on today's webinar, and I'm going to turn it over to Chris Lawton. Chris?
Thank you very much, Bob. Before we begin, I'd like to give a profuse thanks to the 29 supporting organizations who have helped promote this webinar series. Many of these partner organizations have training and technical assistance programs of their own, so we would encourage you to look up the organizations in your area to see what additional programs are offered by our supporting organizations. Today is session one of a three-part series. It will cover understanding financial statements and improving profitability. We will talk about the importance of good records, then we'll go into understanding financial statements, and we'll cover the three major financial statements that businesses use: the balance sheet, the income statement, and the cash flow statement. We'll talk about some key economic concepts, and then we'll review 5 keys to profitability, those being capacity, productivity, efficiency, cost control, and industry skills. I'll turn it over to Caitlin now. Oh, sorry. To run a successful operation, farming, you need staff, animals, crops or plants, feed and fertilizer, land and buildings, and financial records. When we think of starting or running a farm, we generally think of the products produced and the inputs used. Things like animals and crops. Financial records aren't usually the first things that come to mind, but they are just as important. It's hard to survive in any business, whether it's big or small, without good financial records and management, yet they are often overlooked. We can think of financial records like a scoreboard in a game. In this basketball game, it's impossible to tell who's winning because the scoreboard is incomplete. Having poor or incomplete financial records are a lot like an incomplete scoreboard. Every business needs to keep track of the details. You can only manage what you can measure. Without good records, There is no way to tell how you are really doing.
So one part of today's session is someone has to look at the profits. To have a sustainable operation, in other words, one that can be continued over time, it's essential to be profitable. Profits are not the only consideration a farmer needs to think about, of course, but in the end, if you can't pay your bills, you won't be able to survive.
Thanks. So for a manager, accurate financial and production records are necessary to make the most effective business decisions and achieve your desired outcomes. There are 5 steps to this. The first is to identify needs. The second is setting goals and planning. Where do you want to go? Where do you want your business to be in a year, in 5 years? The third is organizing. How will you get there? How are you going to achieve your goals? What needs to take place? Fourth is where the action occurs, directing and executing, making things happen, taking action. And 5, but not least, is monitoring and reevaluating. Are the results what you would hope for? If not, what needs to change? The last point is as important as the ones before. It's always a good idea after results occur to evaluate how your plans worked out and think about what should be done differently next time.
Managers in small businesses are expected to be lots of things: a technical expert, a planner, a doer, a visionary, the spokesperson, a leader, the chief cook, and the bottle washer. With all those things to do, it's easy to forget the role of CFO, or Chief Financial Officer. In today's environment, competition is tough, margins are often thin, input costs rise every year, customers are demanding, and the markets can be volatile. However, every business needs a good CFO regardless of the outside influences.
Next, we'll get into managerial accounting. Managerial accounting is a key aspect of running a small business. It ties together financial and production information. It provides information to help managers make good decisions, which can lead to the completion of their company's goals. Managerial accounting combines 2 types of records: your financial records and your production records. Your business records ultimately should be more than just something you do for tax purposes. They should be a tool that you can use to run your business better, a way to figure out costs, where you're really making money, and where you have room to improve.
Accurate record keeping is very important. Decisions you make are only as good as the information they are based on. Coming up, we're going to review the 3 major financial statements. The first is the balance sheet. This tells you what you own and what you owe. The second is the income statement, which tracks your income and expenses. And the third is the cash flow statement, which shows where your money is going in and coming out.
Great. The balance sheet. The balance sheet is one of the most important financial statements you'll complete when you're running a business. It looks like it's a snapshot in time. It measures assets and liabilities as of a particular date, often year-end or month-end. The first section is your assets, what you own, and these are typically listed on the balance sheet in order of liquidity, or the speed at which they can be converted into cash. So some examples are cash itself in the bank, inventory, accounts receivable, that is money other people owe you, customers that you've sold things to, real estate, prepaid expenses, and machinery. The second section is liabilities, what you owe to others. These include things like loans, accounts payable to suppliers, things you bought on credit, capital leases, and accrued expenses, things that you've accrued but haven't quite got the bill for yet. The last section is your net worth, your assets minus your liabilities, what you're worth at the end of the day.
Thanks, Chris. Next, we're going to go through an example to illustrate the balance sheet concept. In this case, we have an example of a farm with a negative net worth. On the asset side, we have some cash, inventory, and equipment. Note that these items are listed in order of liquidity, or how easily they can be converted to cash. Cash, of course, is the most liquid, and the equipment is less so, as it is generally held for a period of time. Note also that equipment is listed at net, or depreciated value, not historical cost or purchase price. The total amount of the assets in this example is $12,000. On the right-hand side, we have a credit card balance, money owed to suppliers, and a bank loan. These are listed in the order they are expected to be paid back. The total amount of liabilities in this example is $16,700. The net worth of this business is equal to total assets minus total liabilities, or in this case, negative $4,000, $4,700. The reason it's called a balance sheet is that in the end, the numbers must balance. That is, total assets must equal total liabilities plus net worth.
Thanks. Here's another balance sheet example, a somewhat happier scenario. In this case, we took the same assets, the checking account, inventory, tractor, and vehicle, totaling $12,000, but we have less liabilities. The debt is reduced. The credit card debt, accounts payable, and bank loan is less, so we have a total liabilities of $8,000. That leaves a net worth of positive $4,000. Note that the liabilities and net worth compared to assets still balances at $12,000.
Next, we'll move on to the income statement. Unlike the balance sheet, which is a snapshot in time, the income statement measures revenue and expenses over a period of time, such as a month or a year. The beginning is listing all the sources of income, and some examples of that would be revenue or sales.
What about a loan from a bank?
A loan from a bank is generally not reported as income because it has to be repaid. It should show up on the cash flow statement, which we'll go through in a moment, but any type of loan is not considered income. The next part of the income statement are your expenses. Examples of expenses are items such as feed, supplies, or utilities. These items are subtracted from income, and the end result is net income or the profit left over.
Great. So here is an example of a very simple income statement. In this example, our farmer had $4,000 in sales at produce at the farmer's market, and he was lucky enough to receive a $500 gift from a relative that does not need to be paid back. So total income for the month was $4,500. Expenses for the month included labor, fuel, fertilizer, and rent, totaling $1,480. Our sample farmer in this example had net income of $3,020 for the month.
Finally, we're going to go through the cash flow statement. The cash flow statement tracks the flow of cash in and out of your business. Note that it's often very different than the income statement. In this example, the farm actually spent more money than it took in for the month. It paid out $2,000 in expenses, but only received $1,200 from its customers. That left a deficit of $800. It got a bank loan for $1,000 and paid $10 on a credit card. So in the end, the cash flow was positive $190. Now, did this farm make any money last month? The answer is that we can't tell from this statement. There could be several things going on. The farm paid out more money than it took in, but perhaps it generated inventory that hasn't been sold yet. Or perhaps it did lose money and is funding losses with a bank loan. We're not really sure. That's why it's important to look at all three financial statements to get the full financial picture of the business. What this cash flow statement does tell us is that the farm has positive cash flow and is able to pay its bills for the current period.
So can a business be profitable but have a negative cash flow statement?
Yes. In fact, it's a common problem in a fast, young, growing business to have negative cash flow but still be considered profitable. Often that business is building up inventory, investing in assets, or selling goods on credit. All of those can be good things, but none of them generate cash to pay the bills. It's not unusual for a young business to be profitable on paper and yet unable to meet their cash obligations.
Thanks. So all three of those financial statements are very important, and they each tell us different things about a business. Now we're going to look at the two major accounting methods, cash and accrual. Cash accounting is pretty simple. You record revenue when someone pays you for something, and you record an expense when you pay someone else. If you're running a small, mainly cash business, cash accounting may work for you. But as your business grows and becomes more complex, cash doesn't always change hands right away. Sometimes you pay in advance for an expense you haven't really incurred yet. Accrual accounting records income and expenses when they are earned and when they are incurred respectively, regardless of when money actually changes hands. For a simple example, if you put gas in your car, but charge it and don't plan to pay until next month, when would that be recorded as an expense? In cash accounting, you wouldn't record it until you actually pay for it. In accrual accounting, you record it at the time you incurred the expense, in this case, in the month which you took delivery of the gas, regardless of when you actually have to pay for it. Accrual accounting is more accurate because it matches revenues with the expenses used to generate them, even if cash doesn't change hands until later. Another big difference between cash and accrual accounting is depreciation. Depreciation is a non-cash expense, but it's important. It's a factor of how quickly your equipment wears out. For example, if you buy a vehicle for $10,000, does it cost $10,000 the first year and then nothing thereafter? Of course not. That's why you depreciate the asset over time. If you figure the lifespan of the vehicle is 5 years, you would expense $2,000 in depreciation each year to spread out the cost of that vehicle. That's using straight line depreciation. There are multiple ways of calculating depreciation, which we won't get into in this session, but suffice to say, it's a way of accounting for assets that have a long lifespan, like equipment or a building.
Let's look at an example of cash versus accrual accounting for the same business. The cash side is straightforward. Detailed of income and expenses. And in the end, it shows an income of $60. But is this what the business really earned? If we look at the accrual side, what's going to be the difference? Well, the payment on the account of $50 isn't going to be counted because that was income earned in the prior month. But we had $200 in new sales that we won't see the money for right away. We replaced the $300 of labor payment where we made with a higher total of $400 for accrued payroll because our worker put in more hours this month than the previous month. Gas and supplies are the same because we paid cash for them. We don't count the loan payment, but we picked up $300 in depreciation, accounting for the wear and tear on equipment we used to produce our products that month. In the end, we really look at the true income and expenses of our business. We actually lost $150.
Thank you. So there are some very important differences between cash and accrual accounting. Oftentimes, cash doesn't immediately change hands when an expense or a revenue occurs. In the next session, we're going to look at some ways that companies actually make a profit and how that profit gets measured.
So businesses manage profitability in a few different ways. One is, of course, net income in raw dollars. Another way is ROA, or return on assets. This measures the income of an enterprise relative to the assets used to earn that money. In the example here, if a farm enterprise valued at $1.5 million had net earnings of $75,000, that would be a 5% return on assets. Another way of measuring profit is ROE, or return on equity. This measures the income of a farm relative to the amount the owner has invested in it. If the farm has no debt, then ROA and ROE are the same. Let's take the previous example. In this case, our farm, like many farms, has some debt leverage. So we take that same $75,000 in earnings, but this time we divide them against only $1 million because $500,000 of the assets are funded by a bank. This can be a useful way of looking at a farm as an investment. In this example, the ROE is 7.5%, which is good. If the ROE was very low, like 1 or 2%, a business owner might consider whether the farm is really a good investment, and could he earn more money investing his equity elsewhere. Of course, for most people, decisions like that are based on more than just return on equity, but it's important to consider how a business is performing as an investment.
Great. So on to some key concepts. Supply and demand. This is pretty basic and everyone generally understands it, but it's important to still keep it in mind. A lot of farm products are sold as commodities, and for them the price received is a function of both supply and demand. When one changes, so does the price received. If supply goes down or demand increases, prices rise. If supply is up or demand is down, prices fall. Let's think about how this translates in the real world. In the dairy industry right now, for example, the milk supply is up due to herd expansion and growth throughout the country and around the world. Simultaneously, demand is down due to a number of factors. So the result isn't pretty. Wholesale milk prices have fallen tremendously from last year. But remember, things go in cycles. What goes down will come up and vice versa. It's good to keep in mind that bad times aren't usually forever, but neither are good times. It's also important to keep in mind that supply and demand affects you whether you're selling a commodity product or a product where you set your own price, like say greenhouse hanging baskets. If the supply of hanging baskets in your marketplace increases, your price that you're asking, even though you set it, will probably have to go down if you want to sell them. So even if you set your own prices, you're not immune from the factors of supply and demand. Another important factor to keep in mind is the law of diminishing returns. On any improvement, the first improvement you make may have dramatic results, but subsequent improvements may be less dramatic. We'll see a chart on this later.
So here are some supply and demand factors that can affect price. Some things that tend to increase price received are on the left, such as increases in demand, supply of a product that decreases, less competition, price of a substitute that increases, price of a complement that decreases, and some seasonal variations. On the right, there are some items that tend to drive prices down. This is when demand decreases or the supply of a product increases. Greater competition, price of a substitute decreases, the price of a complement increases, and out-of-season variations.
Thank you. Okay, here is a chart of the law of diminishing returns. In this case, it's looking at the number of workers on a job. Say you have a landscape job. With one worker, the project goes slow. 2 workers may double your productivity. Add a third and now you're really cooking. But look what might happen. When the 4th worker joins, the productivity increases, but only by a little bit. And by the time the 6th worker is added, productivity actually drops a little because now there are too many people on the job. Another example might be feed for dairy cows. Improving nutrition improves milk output, but it's not always economical to go for the absolute maximum productivity. At a certain point, the cost of the improved feed ration may exceed the benefit of the additional milk. In these cases, we use labor and animal feed, but a lot of inputs are like this. The first improvement may be dramatic, and each incremental improvement is a little less. The takeaway is that it doesn't always make sense to try and go for the very last additional improvement. In many ways, most small farms live on the left-hand side of this chart, and there is still typically a lot of room for efficiency gains. But it's good to keep in mind that for every input, every technology, there's a period of gains, and then there's usually a point of diminishing return.
Next, we're going to move on to the 5 keys of profitability. When we're breaking down profitability, there are 5 equally important factors to consider, and we're going to go through those next one by one. But here they are listed: capacity, productivity, efficiency, cost control, and industry skills.
Thanks. The first key is correct capacity. It usually makes sense to try and optimize production for the facilities you have. As an example, if you have a dairy barn, it usually makes sense to fill the stalls. In another example, it's hard to heat half a greenhouse. You might as well fill it. Usually, to reduce unit costs, you'll want to use your facility to their optimum capacity.
The second key is productivity and includes quality. In today's competitive market, quality is usually a basic expectation of the buyer, whether you're talking wholesale or retail. A poor quality product will generally result in less revenue no matter how much you produce. A good or an excellent product will generate income, and productivity times quality will multiply your efforts.
The third key is efficiency. This means trying to get the most out of every individual output. Some examples might include sales per worker, yield per acre planted, milk per cow, or production per hour. You want to try and be as efficient as possible with the inputs that you're using in your business to optimize your profitability.
The fourth key is cost control. It's important to manage costs and make sure that as many as possible are directly contributing to your bottom line. This chart has some good examples of different kinds of expenses: variable, cost of goods sold, fixed expenses, and hybrid expenses. As the chart shows, variable expenses are things like feed, fertilizer, direct labor, and supplies. These tend to be linked directly to output. Hybrid expenses are things like rent, utilities, and fuel. These items do vary with output, but not to the extent variable expenses do. The last category is fixed expenses. These items are generally costs the business incurs no matter how much they produce.
Great, thanks. And one thing to keep in mind is that this relates to what they call economy of scale. Things like fixed expenses tend to be diluted if you expand your business. If you expand your business, expenses like insurance and property taxes generally remain the same. So adding more cows to a dairy, for example, typically doesn't increase your property tax rate. So that property tax could be reduced on a per hundredweight or per cow basis. But things like variable expenses tend to increase directly with your output. So if you add more cows, for example, your feed, crop inputs, fertilizer, labor, things like that are going to increase as well. What that means is that if your variable expenses are high, it's hard to grow out of that, because increasing your production typically will just increase your variable expenses as well. Another key is industry skill. These are the skills you need for your particular industry. For example, if you're going to go into dairying, you need to know animal husbandry. If you're going to go into produce, you need to know how to grow vegetables. Industry skills are fundamental to success in agriculture and are really the foundation of your business. We're not going to go into the specific skills for each industry in agriculture today in our sessions, but we're going to talk about how to manage properly your revenue and expenses to optimize the profitability for what you produce. So on to our case study, a greenhouse.
We thought it'd be nice to go through an example of kind of how you guys can think about each of these 5 keys of profitability. And so all of our examples are going to surround the idea that we own a greenhouse and we're running it, and we're trying to use these 5 keys to the best of our abilities. Now, we're going to go through the 5 keys in the same order. So the first one is capacity. And these are the first 2 questions that came to my mind when I think about, how can I best use capacity in a greenhouse example? The first question is, how are we using our land base? The total acreage owned or rented is going to be your total land base, and the area inside the greenhouse where you grow the plants is your productive area. Now, will this ever reach 100%? Well, probably not, because we need roads, equipment storage, and possibly retail space to sell the plants we grow. But that doesn't necessarily mean we're not using the maximum capacity for that space. However, there's going to be a limit to the amount of productive space we can use to grow plants in any given land base. The second capacity question is, are we using the productive space, or the space where we grow plants, effectively? This question relates to maximizing the space inside the greenhouse. Filling the greenhouse with plants is important for a number of reasons. The primary reason, though, is cost. Heating and electricity will be required at the same rate even if the greenhouse is not full, and so you might as well fill it, as Chris mentioned earlier. Reaching full capacity will dilute costs such as overhead and lower your marginal costs on a per plant basis. Labor can also be underutilized if you're not operating at an optimal level of capacity. The second key is productivity. Now that our greenhouse is up and running, we know we are at maximum or optimal capacity. What should be some of our other concerns? Our waste stream is a critical part of this, of productivity. How many plants can we sell compared to how many plants can we grow? And there's a couple of considerations we should think about here. The first is, how many are we selling at full price, which would mean good quality products that we can receive maximum fair market value for. The second would be discounts. Are we growing some plants at poor quality and receiving less than market value or less than we should? The third related to waste is trash. Are we growing any plants that are completely unsellable, and how can we reduce that? The second question that relates to productivity is, are we timing our growing seasons correctly? This would be examples like lilies for Easter or poinsettias for Christmas. Matching production with buying times can also be critical.
Okay, efficiency. This is one of the most difficult to analyze without some industry knowledge. But one way to do it is to track over time against yourself. As we said earlier, this means getting the most out of each individual unit. It combines capacity and productivity. Are we generating the most plants, the most saleable plants, with the capacity we have? One way to track is to track over time against yourself, as I mentioned. Look at your progress year to year and month to month, and consider how each time goes and whether you did better or worse than the time before.
Cost control is the fourth key. And the whole concept behind cost control is looking for ways to do more with less. This can be looking into a new technology such as a more efficient boiler to heat the greenhouse, installing drip irrigation, or buying a tractor to move plants and decrease labor costs. Or maybe it's negotiating with your credit card company for a better rate on transactions. The possibilities are really endless, but when you are determined to monitor each of these things, you'll find a lot of opportunity. Businesses that continue to look for improvement in cost control weather economic downturns much easier.
Great. Industry skill. That's the last key to profitability. Industry skills take time to develop. It's difficult to start a new venture without experience, and for many items in any business, there is a lot of learning by doing. But it's important to know what you're getting into. If you're going to start a new dairy farm, for example, it's important to know something about dairying before you get into it. It takes time, commitment, and drive to succeed from the individual, but it also might take help from peers, mentors, and professionals. A second opinion can sometimes make a world of difference from someone who is not so close to the project. Having a team of outside advisors, whether it's senior people in the industry, relatives, your lender, consultants, or what have you, some advisors that are outside and not completely attached to your business that can look at it impartially can be essential in running a business. So we covered a lot of ground today. We talked about the importance of good records, and we reviewed the three major financial statements and what they can tell us. We covered a couple of key economic concepts, then went over to detail the 5 keys to profitability for a business. There's a couple of things I want to mention on Caitlin's slide that I think are interesting. When we talked about efficiency and capacity, note in this picture here, we're looking at a greenhouse. Note that the picture on the left, they're growing poinsettias. Their floor is full, of course, because they're trying to optimize the space in the greenhouse, but they also have hanging plants to take advantage of essentially free heat that they're using in that greenhouse by having 2 layers of crops growing. So they're optimizing the capacity of the greenhouse. Those hanging plants essentially ride for free and reduce the overall cost, the overall unit cost of the facility for each pot that they're growing. Another thing to keep in mind is to look at the difference between commodity agriculture and agriculture where you're doing retail sales or you're setting your own prices. If you're growing corn, for example, typically the corn buyer will buy as much corn as you can grow no matter how much you grow it. You may not necessarily like the price you get because that's set by the supply and demand in the marketplace, but you don't have to worry about selling the extra acre of corn you planted. If you're growing, say, hanging baskets, it's up to you to sell all those at either wholesale or retail prices. So it's important to consider if you're going to add another greenhouse range or add another 1,000 plants, are you going to be able to sell those 1,000? What's your marketing plan for them? We'll get into that in a future session, but it's important to consider the difference between agriculture where you set your own prices and make your own sales and commodity agriculture. Another example of efficiency is here you can see in the greenhouse on the left where they have hanging baskets growing in addition to the plants on the floor. So moving forward, I'd like to talk for just a minute about Generation Next. This is a program that Farm Credit East offers that's designed to take people's management skills to the next level. It's ideal for young farmers who have existing management experience and education and who would like to identify areas for personal growth and development, gain tools that they can use in their business, and have the opportunity to network with other young leaders in agriculture. This takes place in 3 full-day in-person sessions with a Farm Credit East consultant, and these sessions are offered this fall and winter at select Farm Credit East offices. Be sure to contact us for more information if you're interested in the Generation X program. We'll next take some questions, and we have several that have come in. I'll just take a quick look at some questions that we've gotten. Yeah, Chris.
Okay, first, it looks like we have a few clarification questions, Chris, that refer back to your earlier slides. Someone's asking, do the figures include payments of the owner for his or her time?
That's a good question. There's no set rule on how that happens. Payments for owner labor can be accounted for in one of two ways. It can be accounted for in terms of labor expense, in terms of payroll, if you're an employee of your own organization, or if you're accounting for yourself as a sole proprietor, what you earn would be the profit at the end of the day. Ideally, to manage your expenses properly and account for your own time and the time of other family members that may or may not be working in your business, it's important to account for them in labor. And that will really give you an idea of the true cost of what it costs you to produce your products. So that's a good question to consider. There's not a hard and fast rule of how that is accounted for, but it should be noted when you're presenting financial statements to a lender, for example, whether you have accounted for your own labor, the owner's labor, in the labor line item expense, or whether you're taking your draw out of the profits at the end of the day.
Another clarification question, what is a complement?
Okay, let me go to that slide quickly. A complement is something that goes along with an item. So it's an economic concept. I just got to get to the right slide.
A good example in food is like ketchup and mustard.
Exactly.
Or hot dogs and hot dog buns.
Yeah.
So a complement would be to a hot dog bun. Like you wouldn't want one without the other necessarily. They go together.
So here in this slide, I talked about the effect of substitutes and complements on prices. For example, right now the price of beef is really high. It's falling, but it's still very high. So for substitute meats, they benefit from that price. The price of pork, for example, might grow up if the price of beef goes up, because more people are going to shift their meat consumption from beef to pork, and that increases the demand for pork. So beef would be a substitute, so the increase in price would increase the price of your product. The price of a complement, on contrast, if the price of the complement increases, that's going to decrease the demand for your product. So if hot dogs all of a sudden start costing $10 a piece, the sale of hot dog buns is going to go down because people are going to be buying less hot dogs, so hot dog buns sales will also drop. So that's maybe a little bit of a tricky concept, but substitutes and complements affect your price received and the supply and demand of your products.
One of your slides used COG. What does that stand for?
Okay, we use the acronym actually COGS, COGS, and that refers to cost of goods sold. So if you're, say, a greenhouse and you're growing bedding plants, but you're buying on your hanging baskets because you don't want to grow those, the cost that you're paying for your hanging baskets is going to be cost of goods sold. So if you're buying them in for $5 and selling them for $10, your COGS, or your cost of goods sold, is going to be $5.
Another question that came in is depreciation a cost or a reduction in value of an asset?
It's both. Depreciation is an expense, and it's also a reduction in value of an asset. So it would be recorded in a couple of places. Let me go to the balance sheet. So on a balance sheet, your assets are listed net of depreciation. Sometimes it's itemized separately. So you might see tractor cost $10,000, accumulated depreciation $5,000, net value $5,000. Or alternatively, it could just be listed at the cash value of the depreciated value of $5,000. But you want to list your assets at what their actual depreciated value is. So Depreciation goes on your balance sheet as a reduction in the asset value. It's also recorded on your income statement as an expense. As I said in the presentation, it's the rate at which your equipment wears out. So if you have a $10,000 tractor and the useful life of it is 5 years, you're going to depreciate $2,000 a year on that tractor. And that's different than the rate at which you may pay for the tractor. You could pay cash up front for it, $10,000, and obviously you wouldn't want to expense that $10,000 right away. You'd want to, what they call amortize. You'd want to spread that out over the life of the tractor. Another way to do it is you could finance your tractor. You could have deferred payments or something like that, but it's important to keep in mind that that equipment still has a cost as long as you're using it. So that's why your depreciation is a little more accurate than recording cash payments. So it's depreciation is an expense on your income statement, and it's also a reduction of the asset on your balance sheet.
Great, thanks. These are some good questions coming in. Keep sending them. The next series kind of deals with software and record keeping and accounting. Do you have a good farm accounting structure that could be shared with a program like QuickBooks and used by several farms?
Consultants work with people trying to set up their QuickBooks records or other software all the time. It's really business specific. What I recommend is that you reach out to someone who can give you an idea. There's not really necessarily a blanket, this is how you should do it. It would really depend on what you're looking for, how detailed you want to go, what kind of reports you want to print. There's a lot of variables that wouldn't necessarily work for everyone.
But QuickBooks is a good way to track the expenses. Another common program that's used very often is called Red Wing. That's a software that Farm Credit East uses and endorses. Either one can work, and they're both good ways of tracking your expenses. And there's some features in each program that help you set up things like charts of accounts and expenses and things like that.
I would also say, depending on where you are kind of in your business, there's also some free apps that you can get that are very basic. It's not going to necessarily be able to do everything that you want it to do, but if you're just starting out, there's some good free apps too to just start that process and get used to allocating different expenses to different categories and start your record keeping right away.
So QuickBooks and Red Wing would both generate a lot of the reports you guys talked about today.
Yes.
When applying for an operating loan, would Excel spreadsheets be acceptable to show past income expense?
They could be if they're formatted properly. Basically, any way that you have that you're keeping records of your business, as long as they're accurate and good records, can be acceptable. One thing that's important to note, as a note to your statements, is how you're tracking your own owner's draw, whether that's accounted for in the labor expense or you're taking it out of profits of the business. Another important thing to consider is just making what you present readable and legible to the lender that you're seeking funds from.
And we're going to talk about it more in our final session, kind of the process of getting a loan. But one of the biggest things is just being able to explain how you got at those numbers and the assumptions you made, or how you kind of allocated things. That's going to be what people are looking for. If something looks a little strange, just be honest and open with how you did it, and you should be all set.
Thanks.
Looks like we have one more question here that came in, so if you have any others, now is the time to send them in. How would you explain the difference between ROA, ROE, and ROI?
Okay. Okay. Return on assets measures the return or the profit divided against all the assets that the business uses to earn those profits. So ROA, in our example, if you look at ROA, you would want, regardless of how the assets are financed, if you have $1.5 million in assets, land, buildings, equipment, whatever else, regardless of who owns them, that you would divide your profit against that number, that $1.5 million, and get the return on assets. Equity, on the other, ROE, on the other hand, measures the return against your equity, which is what you actually own. So if you have a business that's leveraged, meaning that you owe a lot of money on it, you have a lot of loans, that magnifies the effects of either your profit or your loss, for that matter. So if you're earning that same $75,000, but you only own $1 million of that farm that's worth $1.5 million, and 500,000 of it is financed, your return is going to be higher because you're only measuring against the profit against what you have personally put into the business. The converse happens if that business loses money, however, and also you'll run into cash problems in terms of trying to pay back your leverage, your debt that you owe. So leverage can improve your ROE, but it also entails risk in terms of being able to pay off your money. So there's not necessarily a better or worse thing there, but they are different. If you're own 100% of your business, you have no debt, ROA and ROE would be the same. As soon as you start leveraging your business, as soon as you start taking on debt, then they start to vary. ROI is return on investment, and that's generally the same as ROE, return on equity. It's just another way to look at the same thing, and it's usually what people talk about when they talk about investments like stocks and things like that. I've got a correction to or a clarification to mention that I talked about software programs, and QuickBooks is one common one that a lot of small farms use. Red Wing is actually the software company of the other program. Centerpoint is the name of the program. So that's one thing to keep in mind if you're familiar with that. And if anyone in this call is interested in software to help with record keeping, please give us a call at Farm Credit East, either at our Connecticut main office or at your local branch, and we can follow up with some more information on that. You'll also have my email address on the last slide when we wrap up.
All right, one more question did come in, Chris or Caitlin. How do you value the property of the farm?
That's a good question. The official way in accounting to value real estate on a balance sheet is at historical cost. So if you pay $10,000 for a field of land, that would be recorded at $10,000 in perpetuity on your balance sheet. The problem with that is that land tends to increase in value. So sometimes you'll see balanced financial statements listed as market value financial statements. So if that land that you paid $10,000 for is now worth 100 grand, you would list that at market value on a market value balance sheet. And that's what a lender is going to look at too, is market value. They're not going to necessarily look at historical value if your land is appreciated in value. So if you were considering like audited financial statements like a big company might use, they're going to list things at historical cost, not appreciated cost. Having said that, for management purposes, it's probably best to have a market value balance sheet and list your assets at whatever their current value is, whether that's gone up in value like real estate has, or even in some cases real estate can decline in value too, as we saw in the housing crash. So it's not a bad idea to include your assets at the actual market value. One thing to consider, and I'm not sure if the asker was getting at this or not, but the way lenders are going to and banks are going to look at the value of property, they're going to look at it at what's called the net recovery value, meaning what the value of that property that the bank would be able to realize if they had to liquidate that in a foreclosure situation. That's not a happy thing to talk about, but it's part of the bank's way that they evaluate the risk of a loan. So if you are financing a house, for example, and you paid $150,000 for that house, the bank might only be willing to lend you $100,000 of that, even though the house might be worth $150,000, because the bank knows that if they have to sell that at auction, they're not going to get the full value. So net recovery value is the way a lender might look at a cost of an asset on a balance sheet. So that's something to note. And we'll talk more about the way lenders think in our third session when we get into lending.
Great. Those are all the questions that came in. This was a great overview. Do you guys have any final comments before we wrap up?
I do. I want to just briefly talk about our our next sessions that are coming up. We have 2 more sessions that are coming up. There's one that's happening at Friday, November 20th, and that's from same time from noon to 1 p.m. And that's benchmarking your business with an agribusiness analysis. This webinar is going to understand, we're going to go more into profit measures, how to set goals and benchmark your business against others in the same industry. And we'll cover benchmarking resources that you can use so that if you're, for example, a greenhouse, you can look at comparing your finances to other greenhouses. It will also cover management styles, gross margin analysis, and it will conclude with a case study reviewing the topics covered in that session. The third session is going to be November 30th, and that's what is a lender looking for. This session will discuss how to finance your business. We'll talk about many different lending options, not just farm credit and commercial banks, but others. We'll cover the 5 C's of credit that a lender looks for. And it'll also include an interview with Keith Steckschulte, who's a Farm Credit East Enfield branch manager. So we'll discuss how to do your homework before heading to a bank and things that a lender is going to look for. Finally, this session will conclude with a review of key financial issues and a summary case study. So registration for both sessions will be individual, and that can be done in the same place you registered for this, farmcrediteast.com/webinars. I should also note that the slides as well as the recording of the sessions, all the sessions, will be posted at that same website following the webinars themselves. So the recording and the slides of today's webinar will be posted within 24 hours at farmcrediteast.com/webinars. Questions or comments on this webinar series or any of our webinar programs can be directed to me, chris.lawton@farmcrediteast.com. And I'll turn it over to Caitlin for some more final thoughts.
Sure, I was just gonna, my email isn't on there, but if you have any questions about consulting, you can email Chris and he can forward them to me, or my email is caitlin.mcculloch@farmcrediteast.com.
Okay, great. Then with that, we'll conclude this meeting. Thanks.
Thank you very much for your attention.
Thank you.